Emerging markets are often in the spotlight for their growth potential. But what really shapes their performance? Let's take a look. First, global growth. When the world economy expands, emerging economies usually feel the lift. For example, countries like Vietnam and India tend to benefit when demand for exports is strong. Second, interest rates and the US dollar. A strong dollar often puts pressure on emerging market currencies and debt. But when the dollar weakens, like we saw after the Fed paused hikes in past cycles, emerging markets tend to shine. Third, valuations. At times, emerging market equities have traded at lower multiples than their developed peers. For example, after the global financial crises in 2008-2009, emerging markets were priced more cheaply than US stocks, yet their economies were recovering faster. That contrast in valuation and growth dynamics drew a lot of attention from global investors at the time. Fourth, political and geopolitical risk. Elections or instability can scare investors away, but once uncertainty clears, opportunities open. After Brazil's elections, for example, markets eventually stabilized and drew investors back in. And finally, diversification. Emerging markets often move to different cycles than developed economies, which can add balance to a global portfolio. So, what stands out? Performance in emerging markets is closely tied to global trade, currency trends, valuations, and political contexts. They can be more volatile than developed markets, but they remain a space that reflects some of the most dynamic shifts in the global economy.